done your business forecast yet? Isn't it called budgeting?
What's the difference?
Yeah, good question. I mean, do I really want to do this? I just started this. I've heard it's important, so I think so. Okay, so how do we create one? And these are the questions that we're going to be covering today. By the end of this video, you will understand what is a forecast, what's the difference between a forecast and a budget, why are they important, and most importantly, how to create one step by step with me. If you haven't met, my name is Julia. Very nice meeting you. I am a former managing director of finance and side hustler turning to full-time business owner. And a big part of what I did in both jobs, in my corporate job and in my new life as a business owner, is to create the business forecast and budget and to manage it every month, to keep track of what we plan to do for the business and what we are actually actualizing, what are we actually doing for the business, doing the analysis of that, and then implementing change in the business. Managing budget and forecasting, it's so important for the financial health of a business, and you as a new business owner or as a business owner should know how to create one or at least understand what it looks like. So let's dive into it. Just 1 second. Let me stop here and explain. The very first thing is, what is a budget and a forecast? Both of them are financial plans for your business. Many people use them interchangeably. I myself have worked at places that called this one document a budget, and the same document was called the final plan in a separate company. And I also worked at a company that called the forecast, but in the second company, the forecast was called the reforecast or the rolling forecast. The important thing here is that they're not exactly the same thing, but they are very similar. Generally, a budget is a fixed document that you create once and you lock it in. So it's a financial projection of where your business is going to be at, usually in the next 12 months. So it's something that you do at the end of the prior year, so November and December, around this time, and you project what your business is going to do from January through December following year. You create that plan, you discuss with people that you work with, or if you don't work with anyone and you're doing that by yourself, you look at the numbers, you tweak here and there, you say, okay, I want to do more revenue, I want to do less expenses, or vice versa. You look at your final result, which is how much money you would actually bring in for yourself as the business owner, and you lock it in. This is a realistic, not a goal setting, not a dream for your business, so you can make informed decisions about how you're going to run the business. Will you have enough money to sustain the level of cost that you're projecting? Will you need to hire people? Will you need to fire people? Will you need to invest in marketing and sales and any other departments to sustain the revenue that you are projecting for your business? So you look at that, you lock it in. Then you would use the budget as the basis for what I call the forecast, which is a more dynamic document. It's a living and breathing document that you will tweak every single month. So at the end of the month, you would look at your forecast, what you had projected for that month and the end of the year. You look at your actuals for the month. Let's assume you're doing January. You projected X amount of revenue for January. But actually, when you close that month, when February comes around and you have everything set in your books, you look, I actually did more revenue than I projected. Will this trend keep going? Will I continue making more revenue than I initially projected? And if the answer yes, you will then modify your forecast. You will tweak them. So the forecast is the actual current representation of where your business stands. So to summarize, many people refer to the budget as this one document that you create once and you lock in place that we use to create the forecast as the base of our forecast. But then we have a forecast or a rolling forecast or several documents called the reforecasts, where every month you would update that initial budget to see where's the most realistic estimate for your business. So now that you understand what they are, why are they important? Why are we talking about this? And why do I suggest you to create one? There's a quote that says, if you're failing to plan, you're planning to fail. And this reflects my feeling about creating a plan for your business. You need to know where you're going. You need to know realistically what your numbers look like, so then you can make informed decisions for your business. The whole point of creating financial statements and doing all the numbers for your business, doing the boring part of your business, is so that at the end you can have numbers and information so you can make an informed decision. Just to bring you back here, imagine that you don't have this plan and suddenly you're spending in marketing, you're spending in sales, you're spending in traveling and company engagements, and then you realize that you stop selling your services. You realize that you don't have enough cash to sustain the level of cost that you've been building. What happens? You go under. You go bankrupt. So to avoid a situation that you get at the end of the year and then you'd realize that you're in a bad financial position, you have to keep track every month of what you've been projecting, where you think you're gonna be, versus what you're actually doing. What is the reality versus what you planned? So this is what we are creating. We are creating a plan for your business, and every month we are going to be tracking to see if you're following the plan or not. And if you're not following the plan, why not? Is it a good variance that we got a bunch of clients and we have more money and we hire more people and we're growing? Or is it a bad surprise that we actually lost money and we are overspending in our business? And this comparison that only happens because you have an initial base, that you have an initial plan, it's crucial to make sure you're not going to go out of business. So you can look at all your expenses and see if you have enough cash in the bank to pay for those expenses. So this is a long way of saying, if you decided to be a business owner, if you decided to take your business seriously, you need a plan. Okay, so I hope I was able to convince you that this is a very important document. So now that you understand what it is and you see that it's important, let's actually create your budget and your forecast for next year. I'm gonna be sharing my screen and we'll continue from there. Okay, so the first thing that you're gonna do to create your budget, you're gonna open your preferred spreadsheet. It could be Google Sheets, which is mine, it could be Excel. You're gonna create a simple budget from scratch. If you use a accounting software or if you use anything to track your actual spending and your P&L, you're going to download a version of your P&L and upload to the spreadsheet. If you don't have anything, you're gonna follow along with me. We're gonna do everything from scratch. So I'm gonna name this the 2025 budget and forecast. And the very first thing that you should be doing is to create a base of your P&L. So we're gonna add a P&L, a basis of the P&L. A P&L is a document called the profit and loss statement. It tracks what it says, your profit and your loss throughout the year. You are going to enter the months of January through December and a total column which sums the months January through December. And I also added here a column for December 2024 because we are going to take the last month of the year, or at least the estimate of what we have in the last month of the year, to use as a basis, as a guide for the next year forecast and budget in this case. So this is a simple P&L. I usually use this business called the Olivia's Copywriting and this persona that I created, Olivia, for the sake of my YouTube videos. So because she's a service provider and she works from home, she doesn't really have a whole lot of costs. This is the idea of her P&L that we're going to be explaining here to you. So let's assume that I am Olivia's head of finance or controller, and I'm meeting with her to discuss the 2025 projections. I know that Olivia is gonna have a December that is gonna look like $10,000 in revenue. So she only has one line item, which is the copywriting revenue. She provides copywriting and she receives payment. So she made $10,000 with this, and she actually has someone working for her on payroll. This person costs, let's say, $1,000 and $500 in taxes. I'm not really calculating the correct amounts here. I'm just throwing a number for the sake of the exercise. The payroll taxes are gonna heavily depend on the state that this person is working and the hours that this person's working, and a full-time, half-time, part-time. So for the sake of the exercise, don't hold me to the exact numbers. Olivia uses software like Google Suite and Slack for communication. So she pays about $400 in software in December. This is what I'm estimating her December to be. She has a few freelancers working for her, so $500 in freelancers. She does $500 in media buying, so marketing, and she travels a little bit to meet with clients in person and to recruit clients face-to-face. So her costs in December are going to be, right now we're talking from a November perspective, around $3,000, so 3.1 thousand, which gives a really strong net income and EBITDA of 6.9. If this is the first time that you're seeing a P&L, there's more that goes into it. Usually you'd have a section in here between revenue and expenses that is the cost of goods sold. But for this exercise, what you need to calculate to make this work is revenue minus expenses. Money coming in minus money coming out. And the result of this is called the net income. So there is something in the middle called the EBITDA, earnings before interest, taxes, depreciation, and amortization. As a small business owner, as Olivia doing copywriting from her house, she doesn't have anything in between. So her EBITDA is going to be the net income, but I'm going to leave it here because it's important for us to start familiarizing ourselves with this concept. So one more ratio that we should include here is the net income margin. This is a percentage for us to calculate what is the percentage of net income based on the amount of revenue. And for Olivia, it's 69%. This is an insane margin. She's only able to accomplish this because it's pretty much a small business. It's herself providing services. There's not a whole lot of cost. It's copywriting from her home, her computer. Most businesses would have a much, much lower net income margin. So, okay, we have established the baseline for our budget. Julia, I don't have a baseline. I am just starting and I just want to forecast. I just want to create a plan because you told me that it's important to have a plan, but I haven't even sold anything. Okay, that's all good. So you will estimate how much you think you will be selling. So how much you think you'll be having in revenue and how much in cost you need to incur to run this business that you're creating. I'm going to bring you in a secret. Creating a budget and a forecast many times is more of an art than a science. You don't really know exactly. All that you can do is to take all the information that is available to you. So if you have a team, you can talk to the team to see, hey, how are businesses going? Like, are we selling enough? Are we losing any clients? Like, you need to touch base with your team. If you don't have a team, it's easy. It's all in your mind. You need to think about what's the probability of me selling more or less, and what do I actually need to invest in this business to grow in the future, to first make it work for this 1 year, to pay the expenses. But then more strategically, you can think, okay, I'm making this a business and I want to grow. I want to invest. So 2025 is going to be the year that I'm going to put a lot of money into marketing and customer and meeting with customers and traveling to expand the business. Or I'm going to hire more people. So because I got to a max, I maxed out my hours. The business is not expanding anymore with my hours. So I need to hire. So I am okay having a lower net income margin, having less money at the bottom line. And this is called the bottom line because it's the last line of a P&L. And I prefer to invest. So this is all going to be dependable on what is your vision for your business. So let's go back to the case of Olivia here. I spoke with Olivia and she said, hey, Julie, this is the year that we're going to grow. Do exactly what I just explained. I want to invest in marketing and I want to invest in more people so I can have more time for myself. So we also talked and she already has a few clients coming in. So we are certain we're going to start January and Q1 with 15,000 in income instead of 10,000. So I'm going to start right there. The first thing that you're going to do is to write down what you think the business is going to achieve in terms of revenue based on the information that you have. So I'm going to start with Q1. I'm going to do 15,000 because this is the information that Olivia gave me. And we have this clients with contracts signed. That's a good start of the year for us. So 15,000, but this client that is going to increase to 15,000, it's going to drop in Q2. They already let us know, like, this is a 3-month engagement. So I'm going to go back to the 10,000. I'm going to be conservative. Maybe we'll find a few new clients, maybe not. So I prefer to be conservative. Olivia prefers to be conservative. And we're going to do a quarter that we're going to regroup and see if we can close any businesses in Q1. But then in Q3, we are positive that we're going to have an increase because of the efforts that we're going to be putting in Q1 and Q2 in marketing. Q1 and Q2, Q3 and Q4, if you don't know, it's quarter. Quarter 1, quarter 2, quarter 3, and quarter 4. You can break the year in 4 quarters. So I'm talking Q1, January, March, Q2, April to June, Q3, July to September, and Q4, October to November. So let's do 12,000, and then we're going to be optimistic that we're going to close the year back with 15,000 in revenue. Realistically, based on what we know about this business, we think we can do 156,000 by the end of the year. This is a great result for us. And now, having that in mind, we're going to go into the expenses, the same exercise. Based on this revenue that we are projecting, based on the numbers that we have
from our contracts and our team and the reality of what the business is nowadays. What is the investment that we need to make sure this business is running? So in terms of payroll, we don't want to take the responsibility of hiring someone, even though we're going to do more revenue in Q1, we're going to go to 15,000, because we already have a strong belief that we're going to go back to 10,000 a month in Q2. And we don't want to have this overhead cost. We don't want to have an additional cost. So even though you're expanding, we want to be conservative in terms of payroll. We are going to continue with this one person making $1,000, and we are not forecasting any increases in their salary. We just hired this person, so it's going to be okay to keep them in $1,000, which means that the taxes will continue to be $500. So in this part here, we won't touch anything. However, we will need additional tools to make our job more efficient. There are a few softwares out there that Olivia and I have been looking at, and we already decided that we're going to invest in software and technology for the business, and we're going to bump this to $1,000. So this is going to be an increase in Q1, and we plan to continue increasing this. So Q2, we're going to increase a little bit more. July, we're going to sign up a new email tool, so we're going to do 2,000 and keep it at 2,000 for the end of the year. So that's a big increase that we are projecting. We are expecting to incur those costs based on the overall situation of the business, based on the decisions that we already made. Again, it's more of an art than a science. Now, we are not hiring new payroll people, but we are hiring more freelancers because Olivia has maxed out. She needs more time for herself. She prefers to invest more in this business and hire more people. So we're actually going to go up to $2,000 in freelancers for Q1. We're going to lower this in Q2 because the revenue is going to lower as well. So we are estimating that we don't need that much help. Then we're going to go back to 1.8 actually because of this revenue that is going to pick up. And again, 50,000, we're going to hire somewhere else and do $2,000. And we know that with freelancers, it's easy to hire and terminate, way easier than for payroll. And that's why we have this flexibility. Marketing. This is the part that Olivia said, Julia, this is the year we're going to invest in marketing. So we're going to bump this up to $2,000 steady throughout the year. And we're going to see what our net income is going to be to see if we need to tweak this plan or not. And traveling is the same thing. Olivia said, I want to travel more. I want to meet with clients in person. That's my strategic planning for the business. So this is what we're going to be doing. And I'm going to bump this up to $2,000. So once I have it at $2,000, I can drag this formula and we have the total net income for the business. Then, more importantly, than creating the budget is to actually look at the budget and see if this makes sense for you as a business owner. And I am looking at this and I'm like, man, we are going from 69% net income margin, taking home 6.9 to in May, taking home only 1.5. This is getting really close to this dangerous zone that like, if we lose a client, we might go under. Like I want a margin that is a little bit better than 15%. So I'm going to talk to Olivia and say, hey, Olivia, in Q2, we need to travel a little less. Like it's better for the business if we want to be conservative to travel a little less. I'm gonna do $800 in here instead of $2,000. And now my margin is at 27. And in marketing, we don't need to go all out in Q2 as well. Let's do 1.5. Now we are above 30% margin. Great. Let's try to get above 30% in Q2 as well. I'm referring to July, August, and September. We are planning to do $12,000 a month each month in Q3. However, we might do more. We might acquire new clients and this could change. But for now, for this final plan that we're creating for the budget for the year that we're going to lock in, we are going to tweak a few things. We're not going to change payroll because that's the hardest one to change. We're not going to fire or hire anyone. But maybe we don't buy that email tool that I was talking about and we keep it at 1.5. So let's keep it 1.5. And now we're almost at 30. And then let's do a little bit less travel. Let's do 1.5 in traveling. And now we are at 31%. Good. So we end the year with a 40% margin, which is still very healthy. I presented this to Olivia. She agrees with it. She thinks that the investment, lowering the profit margin is a good investment, is a good play for this business in 2025. She's happy. So we are going to lock this in, and this is going to be the budget. Okay, so you have a budget now. What are you going to do with it? you're going to first use this as a base for your forecast, for that rolling document, that living and breathing document that you're going to use every month to compare with what you plan to what you actually actualize. What is the money that came in? What's the money that went out? And notice any variances. The budget is great to, again, have a starting point to your plan. And for the next year, when you close the year, you can look at it and say, we thought we were gonna do $15,000 in revenue in December, but we actually did 25. That's awesome. Or you can look and say, okay, I thought we are gonna be doing 37% net income margin by December, and we're actually at 15. Something went wrong. But hopefully you're not going to wait until December next year to compare a full year. You'll be using your forecast, your rolling forecast, to be tweaking your numbers and adjusting your projections, and then what you're actually doing and implementing at a company, right? You can't just adjust your projections and then not take action. You need to adjust your projections, take action, either invest more or invest less, so you have a realistic view during the year while the year is happening. So when it comes December 2025, if you do much better than you expected, or if you do much worse than you expected, that doesn't come as a surprise to you. You know exactly why. So what you're gonna do is to copy the document that you have in here. So I'm going to duplicate, and I'm gonna call this the forecast. I'm also gonna change the colors to make sure I don't confuse them. So the forecast is gonna be green, and this is my forecast for the year. However, once January comes and you already have your actual number for January, right? So let's hide December, and we're gonna be focusing on January. We have our forecast, so I'm gonna copy it here. So now you have your January forecast that you copied from your overall year forecast, and you're going to do January actuals, and then you have a variance, and you have a variance percentage. Okay, so what you're gonna do now is to actualize your month. So let's assume this is February 1st, you already close your books for January, and you have your numbers for the month. So now you did 20,000 in revenue in January. You did better than you thought. In terms of payroll expenses, you capped the one hire that you had. So you did $1,000 in here. You did the $500 in taxes, which you were already expecting. In terms of software, you were expecting to do 1,000, but you went over, you did 1.5. This is Olivia, right? You had to hire more freelancers because your revenue expanded more and you didn't have enough people working. So you had to hire more people. You ended up paying over that you wanted. You paid $4,000 for freelancers. In terms of marketing, you spent a little less than you thought. You spent 1,000, but you traveled. You travel a lot to meet with those new clients, to make sure the businesses were closing, the contracts were closing. So you spent $4,000 in traveling this month, and your total expense for the business was $12,000 while you made $20,000. So your EBITDA and your net income is going to be the 20 minus the 12, which is 8. You don't have anything between EBITDA and net income, and your net income margin is your net income divided by your revenue. So you did 40%. So even though you did more revenue, so let's do the variance column here so it's a little easier. So this side minus this side, and the variance percentage. So this is percentage base, and this is the number variance. Looking 101, you did more, and you can put formulas in here to do red and green and plus and minus, and you can go wild in how you prefer doing this. But the important thing to know is that you did 33% more revenue than you thought. You have no variance in terms of payroll and taxes. In terms of software and tools, you spend $500 more than what you wanted. Freelancers, you spend more than what you wanted. Marketing, you spend less than you had projected, and traveling way more, 100% more. So that caused an additional $3,500 in what you had expected to pay, but you made more money because your revenue expanded and your margin overall was lower than you expected, but you're okay, you're considering this an investment, and you're happy that you did additional revenue. So now what are you gonna do? The important thing is not only to do the variance, but is to adjust the forecast that you created in the beginning of the year because things already changed. You already did more revenue. You already have more freelancers working for you. Imagine if you don't tweak those numbers and then now February comes and you have lower revenue, but you keep all those freelancers. You don't get rid of any of them because you forgot or you're expecting to get enough revenue, but you didn't close any contract. So to make sure that you're keeping track of your net income margin, the money that you're making, you are adjusting the forecast. So this is the last thing that we're going to do. We are going to go back to our forecast, and there's a few ways you can do this. You can save this and call this the January forecast, and then you copy and you do the February on a different line item, and then you keep following the latest, or you can change it exactly here if you prefer. I am going to duplicate this for the next month. I am going to actualize. So I'm first going to copy this and paste it as values so nothing changes, but I'm going to actualize what I did in the month of January. Those numbers are actuals. I'm going to grade out this so I know that it already passed. And now in February, I am going to change this to 20,000 because I'm assuming that I'm going to continue with that level of revenue. I'm going to change March as well. I'm not going to change anything else yet because I don't have enough data. I don't know if things would actually change. I am going to keep these numbers, but software and tools, I'm not going to cancel anything that I got. So I'm going to already change this for the full year. And actually, I'm going to keep the 2,000 that I had in there. So I'm going to change up to September. For freelancers, I had to hire way more than I thought. And I actually know now that I have to hire someone else. So I'm going to change this to 4,500 already from the get-go, which is a big increase. And now my net income went down from 40 to 25. I'm like, no, I can't do that. So let's get a hold of this freelance situation. And I'm going to try to decrease to 3,000 in March. But again, I'm not only changing the numbers in March, I am actually going to take action. I am going to talk to people already and say, hey, your contract is going to end in February, because the important thing here is we were looking at those numbers, we were analyzing the numbers to then implement them in our business and have a better actuals next month. Are you following? So for marketing, I am actually going to lower this. I'm going to match the 1,000, but I'm going to keep my forecast for the rest of the year. And traveling, I'm going to bump it up a little bit as well because Olivia's traveling more than we thought she would, but I'm going to keep the rest of the year. So now I have a new forecast of 35%, which is lower than my initial forecast. And we usually don't want to have anything lower, right? But then again, this is a strategic conversation that you have to have with yourself or with your team, your partners. If you're working for someone, you need to say, okay, based on what we did in January and what you're telling me that is going to happen in the next few months, we're going to lower our net income margin. Is this okay with you? Is this what you want to do? Sometimes you don't really have an option. Sometimes you're stuck with costs and your revenue is going down. In the case of Olivia, she does have an option because revenue is going up and she's deciding to invest and travel and hire people. And she can say, yes, this is the latest that I'm going to do. And this is your new forecast. The important thing is that you keep adjusting your forecast and you know how you are planning to end the year and how are your numbers shaping. What can happen is that you get to December next year and you either make way more money than you're expecting or way less money and you are going out of business because you didn't keep track of this. Like, you as a business owner have to know where you're at. That's the core of the business. If you don't know where you're at, you cannot make informed decisions.
Great. So just to close this up, let's do a summary of what we saw today. We've learned what is a forecast and what's a budget and what's the difference between them. We also understood what's the important of them, because if you're failing to plan, you're planning to fail. And then we saw an example of how you can create a budget and a forecast for your business using a simple spreadsheet. And in this part, it's important to remember, budgeting and forecasting, they're more an art than a science. You need to have all the information that you can, and then you have to create the numbers. You're not gonna be able to get 100% right. That's the goal of a lot of people, to get your actuals to match your budget. But I would actually say that that's not the most important part. The most important part is that you keep evaluating and tweaking your forecast and your budget so that you know what is the most realistic and current state of your business so then you can make informed decisions. If you like this content, please like this video, comment below. I would love to know that this is helping someone out there. I've been having a lot of fun recording those videos, but most importantly, someone has to be benefiting from it. Subscribe to the channel and see you next time.